there he is. All right, Marc Chandler, can you hear us?
I can hear you fine, Blake, and I heard Chris as well. Can you guys hear me?
We can. Good morning.
Good morning.
All right. Well, good. I guess this is as good a time as any. So, good morning, traders. This morning we've got Marc Chandler and Chris Baer with us this morning. Our special guest, Marc Chandler. Marc, good morning to you.
Good morning.
Good. Good morning from New York. So it's nice to have you here today, and I want to first of all thank you for taking the time to spend with our community. I know you're obviously a very busy man, and I just want to tell you how much we appreciate you being here with us. I have great respect for the work you do, as I've told you privately, and most everybody that's listening on this webinar knows in what high regard I hold you and the analysis you do in the markets. So thank you so much for being here today. It's a real pleasure.
It's really an honor for me. You know, I usually deal with a lot of institutional investors. These days at Brown Brothers, I'm dealing with asset managers, mutual fund managers, pension fund managers, sort of what we call the real money as opposed to leveraged funds or corporates. And I began off my career at the Florida Chicago Mercantile Exchange. So I know what it's like to have your own money on the line and not just advising clients on what to do.
Well, awesome. Well, that gives you that extra feel of the markets that I think is lacking, you know, maybe lacking in some parts of the industry. So that's awesome. So tell us, and Chris, and by the way, we brought Chris here, and I'm really happy that Chris is here. Chris actually used to broadcast for our Wise Trade webinars. He did it for a year with us, and we just know that we miss having him around, but he's you know, I want to thank you, Chris, for having for bringing Marc on. I mean, it really is because of you that Marc's here. So
yeah, it's his graciousness. It's really nice of him to put the time in. I got acquainted with Marc from my old days back on thestreet.com, and that was one of the places that had a lot of information about the markets at the time, kind of a front runner of what's out there today. And I would read his stuff and just be wow, great stuff, amazing. And I ended up sending him an email, and he was gracious enough to put me on his mailing list and respond to emails and stuff. And over the years, I've really appreciated it.
well, that's awesome. And Marc, so I mean, you seem like such a gracious person, and again, you know, you're showing here being here with us, and we've got several hundred traders that are listening in right now, obviously wanting to hear from you and your thoughts about the markets. And I guess I wanted to really start off with Chris had a couple questions this morning about what's happening currently in Europe. And Chris, did you want to go into that?
Yeah, sure. Marc is a little bit familiar with the question, but I'd like to just reiterate for everyone listening. My contention, first of all, Marc has been spot on for the last 2 or 3 years, that the political will to keep the euro together and to find a way ends up trumping the circumstances and the mathematical and structural problems. So I just like to get that out of the way. I appreciate that, and I understand that that's not dying, that's actually strengthened. But my question comes down to a little bit of the math, and I'd like some you know, scope on it, some sort of context, because maybe we're talking about something that can be handled easily, and maybe it's not an issue. But here goes. When I look at the size of Germany and their GDP and their own potential problems with population, pension obligations, their own debt, and then I look at the rest of the EU, looking to Germany to help them to you know, more or less create some sort of United States of Europe transfer system. I just wonder how Germany could marry the rest of the EU countries with their current mindset, A, and B, just with the mathematical issues, pension obligations, current debt and rollover, population contraction, unemployment, and it seems to be that Germany's go-to methodology is forced fiscal contraction, and it doesn't seem that that's helped Greece at all. And I'm just wondering how that all fits. So I'm looking for really for big picture, if that can be resolved, and if the context of what I'm saying is just really manageable details. So
yeah, Chris has asked some really tough questions here, because what's involved here, I think, is not just the near term, but it's really the larger European project. And how can it? It's sort of like when the nuts run the asylum. I mean, that's what we're talking about, is where the creditors are in a minority and shrinking, and the debt, not just, like you say, it's not just in Greece or Italy or Spain, but even within the unfunded pensions within Germany. And one of the great things here in the United States has been the shift from the defined benefits to defined contributions, and this has relieved corporates and increasingly local governments in the U.S. from the fixed pension responsibilities. So, I mean, I don't have a good answer for you, Chris. I've been thinking about this for a while. I think about this for myself as well. There's probably no short-term answer, but I think that we have some sense of what the longer-term solution is going to be, because I think you're right that this the debt burden, unfunded obligations are greater than what Germany can afford and what Germany wants to afford. So what's going to happen? Well, I think a few things are going to happen. First, I'm not so sure that there's widespread support at this point for a United States of Europe. I know that after this tough negotiations over Greece, that there was some talk that the European project is over. I don't believe that, but I do think that the move is going to take some time, and it won't be a big fiscal transfer until the debt situation gets resolved. That is, I think that there's going to have to be debt relief either in real terms, that is debt forgiveness, or stretching out the payments for so long. And that's what we're going to see in Greece, where one way that they're going to get debt relief is to stretch out the payments over a much longer period of time. And I know it sounds crazy. It's like, I think you probably say, kicking the can down the road. But I think that there's an important distinction between what we experience as individuals and households, and given our own lifespans, and what sovereigns can do. Think about this, that after World War I, Germany, of course, owed many countries a lot of money. When did Germany end up paying back its debt? Well, it turns out it paid back its debt a few years ago. And that's after many years of debt forgiveness, or many versions of debt forgiveness. In fact, on my blog, I posted a picture of the Greek finance minister signing off on a 50% haircut on German debt back in the early 50s.
Wow.
So, to answer your question specifically, I wish I could, but I can't. I would just say that a couple points, methodological points, to help you think about it. One is that the lifespan of sovereigns is much greater, so which means that they can stretch out these debt payments. Think about what some companies have done, like McDonald's or Disney, where you can get a 100-year bond. Countries can do the same thing. Does it really matter to Germany and its own bookkeeping if the Greek bond it has is for 5 years or 10 years or 20 years? They don't have to mark to market the way we do, and there's a lot of other offsets. For example, in a central bank's portfolio, they think about where the U.S. holds gold versus its market value. And so there's a lot of offsets and cushioning that can be made up through different accounts. But I hear you, and I do think that this is one of the reasons why I'm a dollar bull in the long term. I think that, what's Europe? Many of us grew up in a world in which we're taught in history classes a very Eurocentric view of the world. Those days, I think, are over. I think what we're experiencing in our careers, our life, is really the demise of Europe as the key, sort of at the center of the world's economy. And it's not just happening now because of the euro or because of the Greek crisis, but it really began many years ago. It's really been roughly since the early 80s, early 1980s, that more goods go across the Pacific than the Atlantic. We all know the center of the world's economy has shifted. And what is Europe? It's relatively it doesn't even really exist. I want to say Europe is a man-made, that is people-made construct, political construct of this small peninsula on the western tip of the Eurasian landmass. It has dominated world events, but no longer. It's a older population. Many countries have shrinking population because of demographics and because of a brain drain. Even in the best of times, before the euro's advent, most countries in Europe were lucky to grow 2% a year. In the U.S. and many other countries, 2% a year growth is not acceptable. You know those old New Yorker magazine covers which showed the New Yorkers' view of the United States, which showed New York, Chicago, Mississippi, and California. That is the way I think China views Europe, primarily Germany. And so I do think that our lifetimes, we have to be prepared for not only the rise of China, but the rise of other countries, especially in East Asia, like India, Indonesia, South Korea, maybe United Korea in our lifetimes. And this, I think, really makes Europe increasingly a marginal issue.
Wow, that was a great answer, Mark. Now, that brings up obviously a multitude of other questions. But when you truly believe that this shift, the shift into China and into India and different parts of Asia, it's not going to stop. Even with the recent slowdown that we've seen in China and with some of the demographic issues that a lot of Asia is facing. So you feel that trend is still going to continue even after this multi-decades of really robust growth.
Yeah, I think that you're right. 2 points you make are very, very important. One is that the demographic problem in China is growing. China's demographics look worse in many ways than the U.S., though of course they have a much larger population. But it's a question of perspiration or inspiration, and so far a lot of Chinese growth has come from perspiration. That's just hard work. As people from the rural communities move into the cities, that game is about up, and now they have to begin working more on inspiration, which is really, like we say at the office, working smarter, not necessarily harder. But I do think that I do buy into this idea that the 21st century will be a Pacific century. And the U.S. is a Pacific power, so is Mexico, so is Brazil in many respects, but so is India, China, and I think that this community is really the more dynamic part of the world economy, even though I fully acknowledge that China is probably not growing the 7% that they say they are. It might be closer to 6%. And in the coming years, we should expect something more closer to 5%. But in general, they have the rate of growth, and in India as well, where they still have a young population, not nearly the demographic problem. I really think that investors, such as ourselves, also corporations, they really see the growth opportunities in Asia. And this is going to mean the way products are designed. It's going to mean where products are sourced. It's going to have a lot of ramifications for the global economy.
Very interesting. Now, if you don't mind, I want to shift back over to Europe and back where, Chris's original question. So, in your opinion, how do you feel about, you look at the bigger structure of Europe, what makes it, I can obviously point out the obvious, what makes the United States different from Europe, but where has Europe failed to really, keep the cohesion, if you will, of all these different countries, and because we have a lot of diversity here in the United States. You got, you could take like the economy of Texas versus the economy of Alabama, or other states, or California versus other states, and there's obviously a big, big difference between those two separate economies. Yet we're all the United States. Yet where has Europe failed in that respect? Why can't Europe hold it together as a union? What would your opinion be on that?
Yeah, I'd say partly I have two answers really. One is it's too early to tell. A few years ago, I should say back in the 1970s, I think, they asked the Chinese premier what he thought about the political consequences of the French Revolution, which took place just after the U.S. Revolution. And so this is a couple hundred years later, and the Chinese premier said it was too early to tell. And so I'd say that Europe is still sort of like an unfinished project, and that we're just, that is sort of like, I guess if you want a happy story, it depends on where you stop telling. And so I'd say Europe is it's sort of like my wife gave birth to my son about 16 years ago. In the first 9 months, my son is developing inside my wife's womb. He spends the next, we could debate about how long, I think it's the next 15 or 16 years outside the womb, still growing and developing. Here, the Eurozone is, it's, I mean, 10 years old, 15 years old. It's hardly, this is hardly the end story for the Europe. And so I think partly the problem is that they have birthing pains, and it was born premature in the sense that they do not have the institutional capability that the U.S. does. And I don't mean just fiscal policy, because you think about in the U.S., the first 100 years in the U.S., we have a terrible divide between the North and the South. We don't have a common currency really until the Federal Reserve is created. And so I think that we in the U.S. think ourselves as a finished or semi-finished nation state. Europe is still coming together. Remember, these are countries that have a long history of being, not only have the elites been intermarried, but there's been wars between these countries for eons. And so I think partly Europe is it's an unfinished project. And for me, the political will, this is what Chris mentioned as well, from my view, the political commitment is such that will overcome some economic shortcomings. And so I think that the problem, I think Europe knows its problems. Lack of full integration, even monetary integration is still only half done. We see this on the whole idea of borders, common borders. We see the problems with the refugees. And so I think that this is a birthing problem. Europe is not complete. But I'd say that in defense of Europe, I would say this, that the Eurozone that exists today is a lot different than the Eurozone that was born. And what the founders of the Eurozone and the European project understood after World War II is that countries only give up sovereignty, and that's what it means to be in a union, giving up sovereignty reluctantly. And they only do so when their feet are in the fire, when they have no choice but sacrifice sovereignty. And I think that this is a big crisis, and we're seeing countries give up sovereignty under pressure. And I think this is the key link in Europe right now. It's not so much, I mean, people make a big deal about the banks and the sovereign, but I think the key linkage is between solvency and sovereignty. The less solvent a country is, the more sovereignty that gets eroded. Greece is perhaps the least solvent, and it's lost the most sovereignty. I know former Finance Minister Varoufakis is really upset by this. He wants to re-grab the sovereignty. And I think the only way to regain sovereignty is either leaving the Union, which obviously the Greeks don't want to do, or becoming more solvent. And it's sort of like ourselves. I mean, if we go into a personal debt, the banks and our creditors can take a lot of advantage of us, force us to sell assets, even in a weak market. They can force us to do a lot of things. But once we can regain our solvency, we can become a little bit more sovereign. And I think the same thing for Europe, that this linkage between sovereignty and solvency is really key. And the best things countries can do, I think, is become more solvent. And sometimes that means making hard decisions. That's, I think, what Chris is going to, I think, is partly that we have to really reevaluate, not just for Europe, but even in the U.S., this relationship between the sovereign and this concept that people have suddenly dropped using called citizenship. What kind of basket of goods do we get from the sovereign? In exchange for what? Besides taxes. Is it civic duty? How much taxes? What other obligations do we have as a sovereign? And Europe is also wrestling with these issues. So I think it's a bit early to say this experiment in Europe is over. The U.S. experiment we thought was a great experiment at the time. Can you have a representative form of government over a large territory? Classical political philosophy said you couldn't do it. Europe has the experiment of our time. Can you have monetary union without political union or fiscal union? And I'd say the jury is still out.
Well, okay, so for everybody that all the everybody that says that Europe's it's a failed experiment, in your opinion, it is just too early to make those calls, and there are growing pains, and I can see that, and that was a wonderful answer, Mark. Now I'm gonna shift a little bit to the events of late. Okay, so of the last week, China revalued its currency, and it's obviously thrown the markets into a bit of a tizzy, and a lot of people view the Chinese yuan revaluation is kind of an aggressive move. It's very negative. People put negativity and they attach it to all sorts of different asset classes at the same time. I view the Chinese the steps that they're making there is more of stabilizing their currency after letting it strengthen for many years gradually, kind of taking a different approach to stabilizing their own economy and making sure that it's like a ship and throwing out an anchor, and because the ship's drifting a little bit too far away from shore, they just kind of tossed overboard another anchor to try to anchor their economy. And I don't necessarily view what China's doing as a bad thing, but more of rebalancing their currency. But I'd like to hear your thoughts on the Chinese move last week and how it's going to impact the global economy, because everybody says, oh, now China's going to export deflation, they're going to take away from US manufacturing, or in a lot of different scenarios. So what's your view on the moves out of China this last week?
Yeah, sure. It's true. It seems like China did us all a favor in a way, that Greece was beginning to move off the headlines, and we needed something to keep us going here in August. And the Chinese were kind enough to provide it. What do I think? I begin off by saying that I think that the size of the currency move is too small to be much of a correction to the sharp appreciation on either against the dollar or on a trade-rated basis in the recent years. So I think a 4% move or a 3% move on the currency is too small to have dramatic impact on the world economy, on commodity prices, on the role of the dollar, or as we'll talk about later, I think impact on the Federal Reserve. So why did China do what it did? I think that the move has the magnitude of the depreciation, I think, is minor. I think that is not really what's involved, and we can go into why it's so minor and how it fits into the Chinese economy. But I'll give you the day last week when China did make its move, it moved about 2%. The Australian dollar fell by about 1.5%. And nobody got all excited that this weakness in Australian dollar was going to boost their exports or lift their economy. And I'd say that the same is true for China. So why did they do what they did? I think it has very little to do with the currency level itself, and much more to do with their real strategic aim. The strategic aim is to join the SDR. That's the IMF's special drawing right. It's a basket of other reserve currencies, the dollar, sterling, the yen, and the euro. China wants to join this primarily, I think, out of prestige, out of vanity, sort of like vanity license plates. They say they're part of the big boys club. I think that the important thing is not this level, but the new mechanism in which they say is going to tie the currency more directly to market forces. Now, on a personal level, when someone says something and does the opposite, we accuse them of being hypocritical. But when it comes to politics, I think that there's an important distinction between declaratory policy and operational policy. And they don't always jive. And in China's case, they have said in the past that they'll let market forces move the currency more, and there's still a black box. So I think that they're under a lot of pressure from the IMF. Look at the report that came out a week before China's deval, and the IMF report says something like this. I'll sum it up very quickly. China, you've done a lot of good work so far in order to make your currency more flexible and more internationalized. But we're sorry to tell you, you have more work to do. And among the more work is to make the currency more flexible and easier to access. And so China, under pressure to do so, and I think that the timing of it, like the Swiss franc, that Swiss franc move earlier this year when it lifted its cap, they did so a few weeks before the ECB announced QE. I think China's move, the timing of it, was predicated by the Federal Reserve likely September rate hike. And I say likely only because not only my view, but the Wall Street Journal poll has about 80% or 82% of economists expect that to happen. So China sees that the U.S. may raise rates in September, realizes that the important gap that they were looking at was the fixing, and then the central reference rate at which the Chinese government, PBOC, the central bank, sets every day. And the dollar can move plus or minus 2% of that band, of that level, that central reference rate we call a fix. And so the key rate, the key gap that China wanted to close was between the fixing price and the spot price. And to close that, what they've done is they've weakened, the spot is weakened, and they moved the fix. And my sense is that closing that gap would have been much more difficult if the Federal Reserve raised interest rates and if the dollar rallied afterwards, which are not, as you said, I think, Blake, when you were going over the charts before, it's not necessarily what's going to happen. But that would be the odds favorite scenario, would be the Federal Reserve raises interest rates and the dollar rallies. And if you were Central Bank of China, you want to be prepared for that. And so I think that explains the timing of the move. But the key part of the move is not what appears to be a relatively modest depreciation. It barely blunts, offsets the impact of the rise over the last several years of the Chinese currency, both against the dollar and on a trade-weighted basis against a basket of other currencies. So I think the real intent is about letting market forces have greater sway, and the market forces, as the New York Fed president said last week, Bill Dudley, he used this a clever way to say it. I thought he's double negative. He said that if it's going to follow, that is, if the Chinese currency is going to follow fundamentals, he said it would not be inappropriate if the currency weakens. That's really why I think that China's move is also not about currency wars, though I know that a lot of people talk about it. Look what happened within days of China's decision. The IMF said they welcome it and want to see China implement what it's talking about. My sense is the U.S. Treasury had said the same thing. In fact, I would not be surprised if one day we learned that the IMF was notified about what China was going to do, and that as the IMF was notified, it notified its board, and of course the U.S. sits on that board. Remember what happened when the Swiss moved the currency? Lagarde, the head of the IMF, said something like she was surprised she didn't get a phone call.
Yeah.
Basically, Swiss officials. She didn't say that with the Chinese officials. I suspect that China told the IMF what it was going to do, and went about it, did it. The U.S. welcomed it, the IMF welcomed it, and they want to see more. And so, and some countries in East Asia have already had central bank meetings, like South Korea, which is among the most highly traded with China. And no official has called it a currency war or really complained about what China did.
Okay, so yeah, this is going to be my next question, Mark. So, so no other central banks. We haven't heard any grumblings of, the BOJ. Well, the BOJ held a special cabinet meeting over the weekend, this last weekend, or any other Asian central bank that is upset about the move out of China.
I think that for me that's an important point. The currency war, it seems to me, cannot be declared by the Financial Times or the Wall Street Journal or analysts at banks, but it ultimately has to be declared by other belligerents, other countries who are annoyed with what China is doing. And I think that this is seen as a welcome sign. I mean, the modest currency depreciation of China is not really going to boost their exports. I mean, after all, look at what's happened to Japan. You know, we had a GDP number yesterday from Japan, and they showed, I believe it was a 4.4% decline in exports on the quarter. And this is despite among the weakest of the major currencies. South Korea, same story. They've had a big decline in the currency, no boost in exports. We, I think, as investors and as policymakers or future policymakers, have to really decouple the idea that a weak currency is the key to exports. Even in Asia, it's regarded as so currency falls, say 1%. That's about three-quarters of that. Excuse me, three-quarters of exports is really driven by foreign demand, and only about a quarter of it is seen to be driven by currency movement itself. Think about what happens in the U.S. We import a good from China, and people say, well, the U.S. is going to import deflation now. But follow me on this. See, we import a good from China. It sits on one of the ports, either out there in California or here on the East Coast. Sure. And what happens? That good comes in, and now we have to have, even if that good is all produced with local currencies in China. Think about what happens. It sits in the U.S. So first, It sits, that means storage costs. And then we have to transport it because the U.S. is such a big country, so we send it from the East Coast to the West Coast or from the North to the South. And so we got transportation costs, and then there's marketing costs. Each one of these middlemen involved takes a little cut, of course, and by the time, before you know it, those internally incurred costs, after the good is already here, boosts it by as much as 50%. And so a 2 or 3% movement in currency today won't affect our export or our import numbers for quite a while. That is, a lot of the goods that we're getting now are not just for Christmas anymore, but they're probably already for next spring. Think about how businesses work. So I think the idea of China somehow exporting deflation is a bit of an exaggeration. PPI, the producer prices are very weak around the world. It has a lot to do with the decline in oil prices, decline in copper prices, and only a little bit of that decline is really due to China's currency move, much more to the slowing of the Chinese economy and the world economy.
Got it. Okay. Well, oh, go ahead, Chris, please.
Yeah, I just wanted to ask, and Mark, connected to that, when you look at a free-floating currency like the Brazilian real, that thing's been halved, and you don't hear any. Oh, it's a currency war. So maybe it's just more of a reflection of reality, of where the Chinese currency should be, as opposed to this overarching currency war theme that's so easily sold out there, but I don't think has a lot of legitimacy.
Yeah, I think that, look, I would say, I know you're close to Brazil, Chris, but the Brazilian central bank intervenes almost every day with these swaps. There's another way to hide some of the intervention on reserve figures. I'm sympathetic to the idea that currencies should be moved by the market, but so few countries really believe that. I kind of think once you get past a couple of Anglo-American economies, so the U.S., the UK, Australia, New Zealand, Canada, you really run out of countries who really embrace floating exchange rates. Most countries, I think, feel much more comfortable with a managed float. Think about what happens. I spent my early part of my career on the Florida Chicago Mercantile Exchange, and at the time, where they trade the currency futures? In a quadrant right next to the pork bellies and live cattle pit. And it's one thing to have the price of our bacon or a hamburger decided by futures market and the free market and all that means. Another thing to have money determined by those same factors. And I think that many countries don't like that idea of countries, of the country's currency, the key price in a country, to be determined solely by market forces, which, as you know, can be done, but sometimes by speculation. When I began my career, there's a guy who was Bill Aaron. He was a livestock analyst at Dean Witter, and he used to beat me consistently in our trading contests. And he traded based on horoscopes and astrology, and I never could beat him. He left when we were working together. He left and went to Oscar Mayer. But so I'm not sure if we want the money in our pockets to be determined by such forces.
Right. But what I was getting at is that the central banks, of course, they can control the speed, but I don't think they can maintain the actual level for long against the market. Is what I was getting at. And so I meant, sure, Brazil intervenes, but it's not. Look, they didn't stop anything. The Real's at 348 this morning, or 350. That's just what the market is. It's just not. It's not a control. It's not a completely controlled thing. Although I understand what you're saying is they intervene, but that's just actually. I'm guessing you are much more knowledgeable than me. That's a function of speed control as opposed to that they're going to turn the market.
Yeah, I think you made a good point, and I think about this too because when I think about the big picture for the U.S. dollar. So in my big picture view on the dollar, this is the third big dollar rally we've had since the end of Bretton Woods, which we just celebrated the anniversary, August 15th, 1971, when Nixon closed the gold window. And the two previous dollar rallies, the Reagan dollar rally and the Clinton dollar rally, both ended around the time of intervention in the foreign exchange market. The Plaza Agreement in September 1985. We're coming up to the anniversary. The G7 agreed to knock the dollar down, but I think, Chris, you're right. The dollar actually peaked a few months before the Plaza Agreement, and that allowed the central banks to go with the flow. That is, they sensed a reversal, and they will pile on. The intervention that ended the Clinton dollar rally was against the euro. Remember, the euro was at its record low at the time, around 82.5 cents or so. And that was when Lawrence Summers was the Treasury Secretary. They intervened in October of 2000. And I agree with you. That didn't really mark the end of the dollar's rally. It really bottomed a little bit later than that. But I think you're right that central banks, you think about how big the foreign exchange market is, and this is one of the reasons I love FX. Average daily turnover, $5.3 trillion. It's bigger than the central banks. And when the Swiss lifted its cap back in the middle of January, it looks like the estimated volume that day was twice the average, so closer to $10 trillion. It's the biggest and most liquid capital market in the world. The central bankers can only really influence it by scaring us as investors and by trying to massage the market. And I think you're right that they can control the speed a lot easier. They can get the direction.
That's true with that much turnover, Mark. And still it's a very staggering amount, which kind of brings me to my question to you. And this is the question that I've been thinking, and I didn't prepare you for this, but I knew you'd be able to answer this no problem, or give me your viewpoint on this. The dollar obviously has been I think one of the basis of the dollar rally has been, and the speed and strength of the rally has been twofold. Obviously, the divergence between the FOMC and other central banks globally, as everybody else is, that divergence in monetary policy, obviously is the underlying reason why the dollar has been rallying. But also the flip side is, the dollar didn't weaken as so many people had anticipated over the last several years with quantitative easing. The gold would rally, we'd have runaway inflation. The dollar would, we'd be wiping our butts with dollar bills or whatever you want to say about the dollar. But the dollar's actually shown a lot of strength and never really broke down. And now the dollar's poised and consolidating, and what looks to be to possibly continue. However, the argument that you'll get from many dollar bears is that in the past, when the Fed has raised rates, the dollar doesn't necessarily go higher when the Fed raises rates. My argument is we've been in a very different time these last 7 or 8 years, different than any other time that I've been in the markets, and I've been in the markets for 20. You've been in the markets a lot longer than that. We're in, what people and the Fed has qualified as a crisis monetary policy, keeping rates at ZERP. So how do you feel about the dollar when the Fed eventually raises rates, whether it's September or December or somewhere in between? Do you think the dollar can continue to rally based on what it's done in the past?
Yeah, that's a good question. A lot of our clients at Brown Brothers are also pushing on this point. And there was a Wall Street Journal article, a Bloomberg article, talking about the last 2 out of the 3 dollar rallies. 2 out of 3 times when the Fed has raised interest rates lately, the dollar has sold off.
Right.
I definitely think that it helps in thinking about the markets to know that the markets are not just an aggregator of information, but they also are an anticipatory mechanism. The market, part of the reason why the market is long dollars now is that they're anticipating a Fed rate hike. And so I could see, and I often use in my own analysis, aware of the idea of buy the rumor, sell the fact. And so I can see the dollar, the Federal Reserve raises interest rates. Yellen goes out of her way to explain why this is a gradual move by doing it early and not listening to the IMF, that the U.S. it allows for a gradual process, and that in this cycle, the interest rate, the Fed funds rate, will peak well below the past peak, which I believe was close to 5% or 5.5%. And so I think that Yellen go out of her way to try to put the hike in a context. And this is also why I think that it has to take place at a Federal Reserve meeting that's followed by a press conference. And that, so I could see a case for seeing the dollar come off after the Fed rate hike. However, I don't think that ends the dollar's rally. And I think that this 2 out of 3 times that the Fed's raised interest rates, I don't think it's, I think it's a bit of a curve fitting. And this is what I find analysts and traders do, both on the retail side as well as the institutional side. We have a conclusion in our heads, and we're going to search for the evidence for that idea, and it's a little bit other way around. And so it looks to me like, for example, the how did the Reagan dollar rally begin? Well, I'd say it began under Jimmy Carter, and when Paul Volcker hiked interest rates by 100 basis points overnight. The dollar bottomed in 1978, 2 years before Reagan gets elected, though we still call it the Reagan dollar rally. So obviously he helped with that. But the idea is that the Fed raised interest rates. It took a while, the dollar rallied. Same thing in the Fed began raising interest rates in 94. The dollar bottomed. The Clinton dollar rally began in 95. Remember, that was Robert Rubin and the strong dollar policy verbal support. So in my mind, I would say like this, that the big dollar rallies take place typically after the Fed raises interest rates. Not all interest rates lead to a stronger dollar, but you don't have a big dollar rally without the Fed raising interest rates. And I think what's unique about this is not just that policy is diverging, but that it's going to be diverging for a long time. Think about this. The Fed raises rates. Let's say for the sake of an argument for the Dove, Fed raises interest rates in December. When will the ECB raise rates? Well, we don't know exactly because they're still easing through QE until September of 2016. And what the IMF recently told the ECB is they may have to do more. Any country that's done QE had to do more than they first indicated they would do. What about Japan? Well, many of my friends think that the Bank of Japan is going to have to do more QE themselves. Most people are looking at October, the beginning of the new fiscal half year. And the argument is that, they're expanding their bank's balance sheet. Think about this. When the Fed was buying treasuries, it was buying about $80 billion a month. The Bank of Japan right now is buying the equivalent of $100 billion worth of JGBs, and the economy is roughly a third of the size of the U.S.'s. And they're not just buying JGBs. They're buying everything but comic books. They're buying commercial paper, REIT, ETFs, corporate bonds. And so they're expanding their balance sheet with riskier assets than treasuries or agency bonds. And they're doing it on a smaller economic base, but more aggressive. And, like I say, many people think that they're going from 80 trillion yen a year is their target. They might go up to 90 or even 100 trillion yen. And this is all while the Federal Reserve has stopped easing and is preparing the market for the tightening. So I think this divergence, to me, is the key driver. It's going to last for at least another 4 quarters. So the Reagan dollar rally was about the policy mix. Reagan had his fiscal foot on the accelerator. Volcker had his foot on the monetary brake. The dollar gets squeezed up in that policy mix. Tight monetary, loose fiscal. The Clinton dollar rally happens because of the tech bubble. Money coming into the U.S., into the equity market, Americans keeping more of the money at home. Both of those dollar rallies ended with intervention, or around the time of intervention. This dollar rally, I think, I call it the Obama dollar rally, but it's really more about this divergence of monetary policy. Could call it a Bernanke-Yellen dollar rally, but that even grates on my nerves too. But I suspect that this dollar rally has a long time still in it. I think about, not that history is always a good guide, but we have a small sample size here. And that's really the same thing about this 2 out of 3 times the Fed hikes rates. If I flipped a coin 3 times and twice it was heads, you would not necessarily think I got a big coin. It's too small of a sample size. And that's one of the things I find difference on the institutional side. Sometimes, of course, on the institutional side, people have weak arguments. But I find that many times there's a pushback against things like too small of a sample size, jumping to conclusions, appealing to, just making logical fallacies, typically aren't as common, I find, in institutional research. And that's one of them, is too small of a sample size. And so, but given that too small a sample size, what I did was I looked back at how big was the Reagan dollar rally. It ended up to be about 65%. How big was the Clinton dollar rally? About 45%. And I think that if I'm right and the Obama dollar rally is as big as the Clinton dollar rally, it means that the euro is headed for its historic lows. And this fits in a bit with Chris's view, I think, as well, that something is very unsustainable in Europe. And I think that as we work these processes out, the weaker euro is part of the solution, not part of the problem.
Great answer. Great answer. Well, Mark, if you don't mind, I've got a few questions from our regular listeners, and this one has to do with rate rises, and this is from Thomas. Thomas said, I think it was Greenspan who said, it's the market who would tell us when to raise rates. Based on that, what's the bond market presently telling us about the rate rise, and what should the appropriate 10-year bond yield be to indicate that the rate rise is quote unquote required? I believe the mandate for the Fed has traditionally been inflation. Is there any inflation presently? And if there was a rate rise, what will be the response of the dollar following that in the days? And I think we covered the last question, but I guess the question is, you know, when does the market tell us that we need to actually raise rates, if there is a point, and is there any inflation in the U.S. economy whatsoever?
Yeah, good question. I think that the first thing I'd say is that the best place to look for Fed views or Fed expectations is not the long end of the curve. That would be the 10-year bond, but much shorter term. That's why I use the Fed funds futures, the 2-year note, and the coupon, and the short end of the coupon curve. Here's part of the reason why, and I think this is what we should be prepared for as investors. It was called the Greenspan conundrum, and this is when the Federal Reserve was raising rates, short end of the curve, obviously higher yields, but the long end did not rally, and this is why Greenspan basically argues that he's not so responsible for the housing market bubble. He says he was raising rates at the short end of the curve. Why were long-term rates not following suit? And Bernanke gave us the answer, or gave us one of the answers, and that is that foreigners, non-Americans, like our bond market. They have too much savings and not the financial capacity to absorb their own savings, so they export their savings to the U.S. Greenspan conundrum. And I think that we should be prepared for a return of this. Fed raises rates at the short end, but I'm not so convinced with the Bank of Japan easing, European Central Bank easing, most central banks in Europe easing, China easing, that this is going to produce downward pressure on U.S. long-term yields. Second thing I'd say to Thomas is that the Fed has two mandates, and the Federal Reserve, the current mindset of the Fed, and this is what I find also a difference between institutional and retail analysts, is I find that I began my career off, as I said, on the retail analysts for Dean Witter, that the issue really is not so much what we think the Fed ought to do, but what the Fed thinks it's going to do. Trying to guess what the Fed's going to do, not what the Fed ought to do. And the Fed is telling us that they believe in the Phillips curve. And I'm not going to get into the big math of it, but it's basically this. If your labor market gets tighter, that's going to push up wages. Higher wages is going to push up core inflation. Core inflation will push up headline inflation. They believe this chain of argument. And Yellen has come out, and who is, by the way, one of the leading labor economists. She believes that. They embrace the Phillips curve. So what they think, the Federal Reserve thinks, is that as long as the labor market continues to tighten, that is, that slack gets absorbed, it will eventually push up wages, will eventually push up inflation. And Yellen's been clear about this too. She says she doesn't have to see higher inflation to be reasonably confident. That's the bar. It's not beyond reasonable doubt. It's reasonable confidence that inflation will rise on the medium term. So I agree with you. I mean, I know that my family experiences inflation. It is a headline inflation. It is the food prices. It is rents here in New York. But there's some offsets to it. Price of computers has fallen. Price of gasoline has fallen. Net, whether you look at the PCE, the personal consumption expenditure deflator, you look at the CPI headline, you can see inflation. The Federal Reserve argues that core inflation is the key signal. That is, over time, and that's going back to the 1960s, that headline inflation converges to core inflation, not the other way around. And so,
Great.
Do I see inflation now? I see some signs of it, but inflation is a bit like toothpaste. Once it comes out of the tube, it's very hard to push back in. And so the Fed is trying to be careful here. I think they've been patient already, and I think that they've done everything but tell us exactly when they're going to raise interest rates. They tell us they will raise interest rates this year, and I think that they will, provided that there's not another little accident with employment data. I don't think it matters what happens to oil in the short run. I think the Federal Reserve needs to show that it's independent of three people, or three things: the IMF, Beijing, and ourselves as investors in the stock market and causing a little bit of volatility.
Great. Well, that actually brings us into the next question, which Paul Franco, which you know Paul, SPZ trader, he said his question was regarding the possibility that the Fed does not hike in September due to the 2% inflation target. And I think you just talked a little bit about that. In the July FOMC statement, the Fed noted inflation continued to run below the committee's longer run objective, partly reflecting earlier declines in energy prices. But they removed the line, energy prices appeared to have stabilized. Since the FOMC meeting, crude has fallen nearly 15%, and also the PBOC has devalued the yuan, suggesting in the near future that the U.S. may encounter deflation as a result of China's actions. These two critical developments would provide the Fed cover to sidestep September, resulting with the dollar to be temporarily reined in, lessening the impact to the broader economy and helping deflationary concerns. What are your thoughts? Thank you.
Yeah, no, that's I follow Paul closely, smart guy. I tend to think that here he's exaggerating the role of commodity prices on Fed thinking. Remember, the Fed, they look at core inflation that strips out in the U.S. Food and energy. I think that, this is one way that the U.S. differs from a lot of other central banks. Think about what happens. July 2008. Oil prices are near $160 a barrel. The ECB raises interest rates because they think higher oil is inflationary. The opposite of that, the drop in oil prices, is it really deflationary? I don't think so. Here's why. Is that first I'd say that in the U.S. we tend to typically experience a drop in oil prices as a tax cut for consumers. The less money we have to spend on gasoline to fill up the car, the more money we have to buy other things, iPhones, computers, take the family out to a restaurant. And so in many ways, I think that this drop in oil prices should be a stimulator for the economy, and it's come at a good time. It's almost the equivalent of a QE. Drop in oil prices helps offset the other headwinds that are still affecting the U.S. economy. So I think Paul's right, though, of course. Myself, I had thought that the Fed was going to raise rates in June. And after some softness in Q1, I realized that June was the first opportunity, but not necessarily the best opportunity. We quickly shifted to September, but it's possible. And I think that the drop, as Paul notes, dropping to that line about energy prices had appeared to stabilize. Dropping that from the FOMC statement gives the Fed a way out if they need to come to September FOMC meeting. My thinking is the Fed's going to look past this. They told us that a drop in commodity prices only temporary impacts measures of inflation. And so I'd say that, again, that the Fed's target, Fed has two targets, and it's subjective. If you get close to one, full employment, how far can you be from the other one, inflation? And I think the Fed's telling us that they are not too disturbed by the decline in oil prices, that unlike the ECB, the Fed tends to view the drop in oil prices as stimulative for the consumer.
Great. Now, Scott, he's rather concerned about the current environment. He says global economies / political systems are in high turmoil. Historically, this has been it has the potential to lead to broad or global wars. How possible or probable is this? Could this be a catalyst for renewed growth in commodities and commodity-based currencies?
Yeah, go from currency wars to the real thing, huh? I don't know. It does concern me that I think about how the U.S. and Western Europe get out of the Great Depression, a crisis that was perhaps in similar magnitude as the one we just experienced. And I think of the combination of nationalism and socialism. And I think that some countries, you see this already. I mean, what Japan has done recently to Prime Minister Abe reinterpreting the Constitution to help strengthen its own military forces. We see Russia not accepting the post-World War II territorial settlements in Europe. We see the growth of ISIS breaking down national state borders. Is there going to be a global war? I don't know. I hope not. I really hope not. But I can see that. I can see the remilitarization below the surface. I can see that in weak economic growth periods, it also exacerbates tension between countries.
Sure.
But I think that this is one of the values of things like the World Trade Organization. These aren't. It's not that it's pro-free trade. What they really are. We're talking about this institutional capacity that's been built. Is about conflict resolution. Now, rather than sending out gunboats, we can take a case before the WTO. But the creditors, as the U.S. did under gunboat diplomacy, doesn't have to take troops into countries who owe us money. Look what's happening in Europe. The EU is sending an army of bureaucrats wearing suits and ties and carrying calculators or smartphones to do books, to embed themselves into the different ministries in Greece. This is a loss of sovereignty, and I hear some of you, complaining of that this is just a form of imperialism, but I think this is a much better variation than military troops. So I'm not in the near term, say the next year, 2 years, 3 years. I don't see the basis of getting too concerned about a global war, a military war. Yes, there going to be tensions in the Pacific, tensions in the Indian Ocean, tensions in the Middle East, but in general. I think that global war, I think, is a world war. While not unthinkable, I don't think is very likely.
Okay, thank you very much. And the last question that comes from one of our viewers is from Zach. He says, he asks, given the caliber of Marc Chandler, what I'd love to understand is what he considers to be the most important thing to keep in mind when analyzing central bank words or actions and then arriving at the most probable FX outcome. So how do you translate, the verbiage or the communication from any central bank and relate that to the currency market and to make an actionable idea?
Yeah, this is one thing I think that lets us keep our jobs, and computers can't replace us, because it's really more of an art than a science. So I can tell you a couple of rules that I've developed. For me, for example, the Federal Reserve, I want to keep my eyes and ears on the signal, not the noise. And I find that maybe because I spent some time in China recently, I kind of think that the Federal Reserve is a lot like the Chinese Communist Party. And there's a central committee.
Yeah.
And it's out of that central committee that policy emanates. The Federal Reserve, we're a democracy, everybody's got to vote, but not everybody's equal. And for me, that central committee of the Federal Reserve is 3 people: Yellen, Fisher, and Dudley. They stick to policy, they stick to message. Other people can talk, they're not necessarily on message. And I find that the organ for their views is the FOMC statement. So I know tomorrow the minutes come out, and it's going to be worth some headline shockers, perhaps. But to me, the minutes, everybody gets to talk in the minutes, and you don't really get the context of the argument so much. So I think the minutes tend to have a higher noise to signal ratio. And I think the same thing about the dot plots. For me, the most clear organ of the Central Committee of the Federal Reserve's view is the FOMC statement itself. My understanding is Yellen or someone in Yellen's entourage writes the statement, and then if one disagrees with it, one can dissent from that. But there's no dissenting from the FOMC minutes or from the dot plots. The second thing I would say is that what central bankers say is not as important as what central bankers do. And so I hear you. I mean, the ECB Draghi says he'll do whatever it takes, and the market responded to that. But what really counted was the measures that he offered, that OMT, and which finally got constitutional approval from the European Court of Justice. And so again, I try to focus on the signal, not the noise. And it's a subjective decision about who's really the signal and who's the noise. I think that other central bankers. I have a friend who used to be a prop trader here in New York, and he ended up becoming mayor of his small town in New Jersey. And what happens is that we have it was a weak mayor's organization where the alderman basically elected the mayor. So some countries have central banks where the committee is more important than the leader. Maybe Sweden would be an example of that. Bank of Japan, the ECB, and I would argue the Bank of England is much more strong individual. That'd be the strong mayor model as opposed to the weak mayor model. And so I tend to focus then on the key there, and as well as try to understand what the targets are. So again, the point is not so much what I think the Bank of England should do or the Federal Reserve should do with the BOJ. It's worth talking about at a cocktail party or over a pint or something. But when it comes to the markets, what I'm trying to figure out is what is the central bank going to do, and how is the market positioned for that? To me, those are the only two really relevant questions. What they ought to do is more philosophical, and of course, as a Cubs fan, I can always judge what the coach and manager did and what they should have done. But in the markets, my goal is trying to understand what they will do, which is hard enough of a task for me.
Great, Mark. That was a great answer. And, you know, I've got about 30 other questions I'd love to ask you, but unfortunately, we kept you here for an hour, and you've been so gracious with your time. And I just want to tell you how wonderful it's been to have you here today. You've been wonderful, and to answer all these questions and spend the time with us. Kip Cohen is he hosts our stock market broadcast. Kip should be actually here right now. Kip, are you there?
Good morning. Yeah, been listening
and Kip, Mark, Kip.
Hey, Mark, good to meet you.
Thanks, Blake. You'll have to have me back on sometime.
You know what? I would love to have you back on, Mark. You've been just truly a pleasure. We loved listening to you. Your ideas are great, and you know, and I know many traders just hang on your every word. Chris Baer, are you still there?
Yes, sir. I'm here. Thanks.
Any last parting comments to Mark?
Okay. Yeah, Mark. Just thanks so much, and I'd like to hear next time maybe you talk a little bit about how you feel with the Federal Reserve being the basically the bank of the world, because most of these countries have these emerging market countries have dollar reserves. So especially Brazil this time is not as in bad trouble as they were last time. So I'd love to hear you expand on that concept, that idea. But it was great, wonderful, yep. Absolutely.
And Mark, we'll have you on next week. So I'm just kidding. I'm joking.
Once a week, yeah.
So, Mark, thank you so much for being here today, and we really appreciate your graciousness.
Thanks. Good luck to everybody.
All right.
Thank you, Mark. And that was Marc Chandler, everyone. And thank you, Chris, for being here today as well. You're always great to have around.
Okay, Blake. I'm out. Kip, good talking to you. Hope you guys are well, and hope all the wise traders enjoyed it. I'm out.
All right, thank you, Chris. Thanks for organizing this. And Chris, Chris, Kip, I don't want to take any more of your time, but what a great interview, wasn't it?
Wow, yeah, fantastic. It's just I think it's great when we do stuff like this and bring these very intelligent, very just great market knowledge guys to the show. It just adds so much.
It really does, and so what a gracious host. So when I thank Mark on Twitter today, if you guys can thank him as well, you know, just thank him for his time. I'd appreciate that. And you guys have a great trading session. I'll see you in 3 hours on the Lunch Money webinar. Kip, have a great day.
Thanks. You too. Talk to you later.
See you guys. Bye.
Bye bye. All right, guys. Good morning. Welcome to the opening bell.